You may have heard about the new tax law, but have you ever wondered what taxation in Nigeria looked like before now? Today, we'll be discussing why Nigeria abandoned its old fiscal system in favor of this new one. Hi there! Welcome to the premiere episode of What's New About the Tax Law. A study by PwC revealed that about 22% of people who evade tax do so because they believe that the rules are unclear and the process is just too complex. Even the former chairman of the Presidential Fiscal Policy and Tax Reform Committee, Professor Taiwo Oyedele, disclosed that about 98% of the workforce suffers from multiple taxation in the old system. The truth is, the old taxation was cluttered with so many laws and levies that discouraged people from fulfilling their civic obligations. For the average company, tax compliance used to require a team of accountants just to keep track of overlapping deadlines and conflicting documentations. That wasn't the only problem. The tax administrative authorities were equally multidimensional, leading to so much confusion and distrust among the people. If you were a tailor, a shop owner, or a businessman, you didn't just pay one tax, you were hit with multiple taxes, small taxes, every corner. It was hard to know what to pay, who to pay to, or how to pay. This confusion also created a gap that allowed the fake tax collectors to come to your offices or businesses and harass you for unauthorized taxes. When tax laws are fragmented, it's incredibly difficult to pass meaningful relief packages because the relief given by one law is cancelled out by another levy from a different law. Nigeria is not alone. Other nations have suffered similar fiscal challenges and achieved enormous economic growth after appropriate fiscal restructuring. Emphasis on appropriate. The International Monetary Fund and Organization for Economic Cooperation and Development have continually made references to the successes of Georgia and India after an exhaustive overhaul of their fragmented multi-layered tax system. Now let's look at Georgia. Georgia's fiscal system was characterized by a widespread of corruption, a high number of complex taxes, low tax compliance, and an inability to meet budgetary obligations, resulting into severe chaotic economic environment. By 2003, the government was unable to pay salaries, pensions, leaving public finances in shambles. Now, in 2004, the tables turned, and Georgia executed a very successful tax overhaul that slashed 21 taxes to just 7 and introduced flat rates for income and corporate taxes. The result? They recorded an improved tax to GDP ratio from 7% to 24% in 9 years, while corruption decreased drastically. Now, you may think Georgia is far-fetched. Let's look at India. India had a high fragmented and indirect tax system like Nigeria. It was characterized by a cascading effect where taxes were levied on top of other taxes, increasing cost for businesses and consumers. Then in 2017, India replaced the complex web of central and state taxes with the Goods and Service Tax, GST, which unified the single market of 1.4 billion people and removed interstate barriers. Due to this reform, research at the Gokhale Institute of Politics and Economics indicated that every 1% growth in GST revenue correlates to a 0.56% increase in GDP, simply meaning that there was an increase in the country's GDP just because of this reform. Nigeria's tax system was in the same dilemma as India's and Georgia's before their major reforms. Imagine taxpayers facing over 60 different types of taxes and levies. It was not just complex to understand and comply with, but the taxman had enormous challenges administering his duties as well. In light of these challenges, in July 2023, President Bola Ahmed Tinubu, in his visionary leadership, formally inaugurated a tax committee to meticulously review and reform Nigeria's fiscal system, expand its narrow revenue base, and reduce pressing cost of living challenges. The committee was broad and comprised of a multi-sector coalition of experts, including leadership and technical advisory experts, private sector bodies, revenue agencies, ministries and economic institutions, legislative organs, and international observers. After several months of planning, on June 26, 2025, the government finally passed the new Tax Reform Act into law, which was slated to take effect by 1st January 2026. It marks the day Nigeria consolidated its old scattered tax laws and adopted a simple, streamlined, and consistent tax system. So, by bringing these isolated laws under one roof, the government effectively killed off dozens of low-yield taxes that cost more to enforce than they actually brought in. The new streamlined approach has now simplified the entire process, swapping bureaucratic headaches for a single, stable framework. So now, we're moving from a messy, confusing past into a simplified, efficient future. But you might be wondering, how did this reform come about? What were the processes that birthed this new tax era in Nigeria? Who were consulted? Were there any trade-offs? In our next episode, we'll talk about how the tax consolidation discussion finally became law and the brains behind it. Make sure to subscribe to Tax TV on YouTube and follow us on all our social media channels on your screen. See you next time. I remain Dolapo Obafunmi.